This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Eric, let's talk some charts. Listeners, you're going to find the download link for the Postgame chart deck in your Research Roundup email. If you don't have a Research Roundup email, that means you have not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the red button over Louis' picture saying, looking for the downloads. Now, Eric, let's cover crude oil starting with the EIA inventory.
EIA printed a drawdown of 2.1 million barrels nationally and also another draw of 2.1 million barrels in Cushing, Oklahoma. Now, I can make an absolutely certain guaranteed prediction that we are not going to see another 10 weeks of Cushing drawdowns of this magnitude because there's not enough oil in Cushing to have that many more drawdowns, and it can't go negative. They are not actually at tank bottoms in Cushing, but they're down to about 23 million barrels. That's basically the absolute bottom of the safe operating level. They haven't run out of oil, but they're at the bare minimum that they need in order to keep all of their operations running. So we've got a real situation. I'm pretty sure that's the reason that we had an explosion in the WTI time spreads earlier this week. That's coming back under control now, but they're still very high, and I expect them to continue to blow out. Gasoline drawing down 831,000 barrels, distillates drawing down 2.9 million barrels. So we've got drawdowns across the board. U.S. production holding steady at 12.9 million barrels. As I said last week, the market was already overbought then and overdue for a pullback. It just kept powering higher as we've seen so much physical market stress, and people are starting to finally focus on supply, which is where the story is really going to be. Looks like this correction has finally started now, but hey, look at how shallow the last couple of corrections have been. I'm already starting to buy the dip here. I hope it dips further. I'd love to see at least back down to some of the lower moving averages, down around $84, $85. But I'm going to be buying all the way down. I do think the move higher is on, and I don't mind admitting that I've missed some of this move because I was holding out for a deeper correction and didn't get it. So I'm not going to repeat that mistake a second time. Now, our good friend Dr. Anas Al-Haji has been predicting all year that oil prices would be strong this time of year. Well, he got that one right. But then he said, be careful. Don't expect $100 oil prices, because he predicted that China, once we got oil prices back up to a reasonable level, Anas predicted that China would begin drawing down its SPR and selling into that strength. Just this week, Anas has a research note out to his paying subscribers confirming that that's exactly what's happened, that China has begun to draw down, only in a small way so far, but it is a drawdown on the SPR in China that they had been building until now. So it looks like maybe Anas is starting to be proven right. That's only a couple of weeks. Let's wait and see how the data shapes up. But there's reason to think that we may be nearing the end of the move up in price that Anas predicted in 2023. Maybe we're going to have a little bit of a reprieve here. Maybe prices will come back down for a while, and then we don't see them move over $100 until 2024. That was certainly Dr. Anas Al-Haji's outlook. I'm going to say he's a very smart guy, been around the oil business a lot longer than I have, but I still see plenty of reason for China's strategy to change based on geopolitical developments and to get right back to $120 per barrel oil before this year is out. I'm not predicting that that's going to happen, but certainly it wouldn't take much of a geopolitical escalation for that to happen, and who knows when that's coming.
Yeah, Eric, when we just look at oil technically on page 2, we had a really solid advance that approached the September and November 2022 highs. And so we now have traded to some overhead resistance. It's a very typical place where a rally can get checked. I mean, there's plenty of room for a $5 pullback in crude oil. It may approach its 50-day moving average. But my position is that there's a primary new bull trend trend, and old dips should be bought. So I'm not looking at shorting oil in any way. It's likely to pause, but it should be bought on dip, and I still think we could see $100 even this calendar year. So, Eric, I wanted to move on to page 3 and just touch on this S&P 500. And more importantly, for the entire period since Labor Day up until this FOMC, more or less the market's been pinned in about a 50-point range, give or take. I mean, we had a couple little swings, but more or less we had the option expiration gamma pins driving deeper or sideways consolidation. And really, there was no reason for market volatility to return until we were in this post-FOMC period. But what we had here was Powell came out with a bit with the hawkish tilt, and the market just didn't like it at all. And we've seen now a very decisive breakdown below 4,500, which was my line in the sand. At this moment, the path of least resistance is for this to drop even 100 further points down to around 4,300. Now, is this that scary, ominous market crash kind of scenario where we head right back down to 2022 lows? I think it's a little premature to be talking that, but the way I look at it is I'm going to look for this drop toward 4,300. Going to see how the price action stabilizes there, and if we see that a negative feedback loop starts perpetuating some liquidation and volatility starts causing more and more traders to unwind some of the heavy leverage and maybe some of the short gamma positioning that might be out there, that could lead to some more selling. But right now, 4,300 is my short-term target. Let's move on, though, to the dollar. What are you thinking here?
Well, we're just barely holding under 105, which is an important resistance level, as you've pointed out, Patrick, in previous weeks. So we need to watch that closely. If it breaks above 105, then, of course, the question becomes, what's the next level above that? What we know from talking to Brent Johnson that he thinks a retest of 115 may be in the cards. I can tell you if that happens, it's going to break a whole bunch of other things, but I'm not going to tell you it's not going to happen. Right now, though, until we get above 105, I think it's hurry up and wait mode. But boy, just looking at the chart, it looks like it's trying to break out of that 105 level.
Yeah, the U.S. dollar index is trading right up along the 2023 highs. But this is a real big tell for me. We had a couple little pullbacks over the last couple weeks, and each time the dollar got bought on dip. And so now almost all the major central banks have spoken. And so it's going to be really interesting to see if we see risk off perpetuating, a risk off scenario of a strong dollar and weak risk assets. Really feels like the likely scenario, at least in the first day after the FOMC. And so let's see whether this causes a breakout on this. A dollar, trading above 106. Really, at that moment, you got some fib retracement zones in that 107 to 109 zone. But really, it could start a process where the dollar could go back to retesting some of those 2022 highs. Now, I'm not calling for that yet, but we're at a very critical overhead resistance, and we'll see whether or not dollar strength can continue. Moving on, though, Eric, on page 5, I have the gold futures, the December contract. What are you thinking here on gold?
Well, last week I said 1926 on the December contract is the critical price to watch on the gold chart, and I did not expect it to hold. Well, I got that one wrong. It did hold, but I'm not convinced it's anything more than just a dead cat bounce. And I also want to point out that Wednesday's closing print, I put closing print in air quotes there, above the 100-day moving average is an illusion. That's a funky contract, gold. For some reason, it has a closing hour of 11 o'clock, I believe. It's not the 2:30 that most of the other futures contracts expire at. The point is the close on gold on Wednesday, that really high print that you see, 1962 or whatever, that's not what the price of gold was after Jay Powell spoke in the afternoon. That's what the price was in the morning. When Jay Powell spoke in the afternoon or after Powell's speech is what matters as far as I'm concerned. And we're right back down to where we started before that rally began. So don't don't be duped by that signal. I think we're probably headed down for another test of the 200-day moving average. That's 1927 or so. I won't be surprised if that's tested again. So let's wait till next week and see if we're above it or below it. But so far, I don't think the bounce that we've seen necessarily has legs. If it gets above the 100-day moving average and really and truly closes there, that would definitely be an indication. But so far, it's been rejected and rejected pretty firmly.
There's all these little bounces in here, Eric, but every rally's been failing. Gold has not been able to show any accumulation. Every time gold pops, it's sold in its distributive price action, and it's not typical for gold to be doing well in this period. So at this juncture, with us in tight liquidity conditions, higher interest rates, and a dollar strength, really hard to make a case that there's at least any immediate reason to be bullish gold. If we see any breakdown towards 1900, it could really make a spill down to 1850, and if the selling is intense enough, maybe we go back to 2022 lows. Now, I'm not that bearish, but right now there's nothing bullish to say about this chart. Continues to trade below that 50-day moving average. It's very distributive price action. I think in the bigger picture, especially when we're in the next phase of the monetary cycle with some sort of easing, maybe in 2024, we could see an environment where gold could have some bullishness then. But on the short term anyway, this trend of weak gold is likely to persist. What I wanted to just touch on finally, though, Eric, is looking at page 6, I have the volatility index, and I was really surprised that going into the FOMC and going into that seasonality of high volatility in October, that the VIX was trading in the low teens. We talked about in last week's postgame, and here we got that spike. We're at the 16 level on the VIX. Now, that's not really danger zone. I mean, we have to see up in the mid-20s in order for it to really be advertising that some bigger risk-off impulse is underway. But what will be interesting, at least this week, is will we get back toward 20 and start consolidating in higher levels of volatility? At this moment, we definitely have a one-day breakout, so let's see what develops from here. Moving on, though, I wanted to just touch on the two charts of copper and uranium. Starting with copper on page 7, a very distinct breakdown back to the August low. We were talking about this 4 or 5 month trade range that's been forming, but the rallies, very similar to gold, have more or less continuously failed, rolling over. There's an immediate downside risk of a breakdown. If copper can't hold these lows right in here, it could really start a breakdown that could send us down to the 3.25 level later this year. So I wanted to wrap things up on page 8 with the Sprott Uranium Trust chart. Now, we talked at the beginning that the uranium is now at multi-year highs on the U308, and this Sprott Uranium Trust as well, breaking out multi-year highs on the upside. And so we have uranium, one of the only real places that has got some genuine bullishness, and it continues to work. It'll be interesting to see whether this can continue. There is nothing bearish to say. Obviously, a little bit overbought. There's always room for $1 or $2 pullback on the Sprott Uranium Trust to just do a little bit of profit taking. But an old dip should be bought, and this trend is going to continue likely to be strong here. At least there's no reason to believe that we've seen a major topping formation.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at MacroVoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.